Beef spending has changed so much since the last cycle highs that most of us don't recognize the market for what it is. Part of the supply chain story that evolving today is how do we make cattle more uniform from the cow-calf level all the way through the feed yard so that more of them end up on the same rail on the same shift. And that's where the money is. If you're a cow-calf producer, this next 3 or 4 years is the time to figure out what part of this system you're going to be part of, because when it turns over, the price spreads, I think, get really wide.
Welcome to the Future of Beef Show, produced in partnership with Drovers and Breeder. This is the #1 podcast for progressive ranchers and feeders looking to run smarter, more profitable, next-generation operations. I'm your host, Jim Johnson, from the Brands and Barbed Wire podcast, joined by Dr. Jessica Sperber, feedlot specialist at the University of Nebraska, and Ian Wheel, founder of Breeder, the cattle tech company helping producers raise, track, and trade high-performing cattle. What's really driving the beef market in 2025? In this episode, we sit down with Dave Weaber, a senior livestock economist within the farm credit system and one of the beef industry's most trusted market analysts, to break down what's real, what's temporary, and where the cattle cycle is heading next. Plus, what producers should be watching that others might be missing. This episode is sponsored by Corteva Agriscience. When weeds and brush get in the way, you'll find the solution at rangeandpasture.com. So, Dave, welcome to the Future Beef Show. How you been?
I've been great, Jim. Thanks for having me.
Good.
Thanks, Ian.
Thank you.
Thanks for the invite. Look forward to the discussion today.
Yeah, can't wait. So for our listeners, tell us a little bit about yourself and your background and why you're the famous Weber.
I'm the better looking Weber.
Okay.
No, I'm Dave Weber, and I'm a research economist for Terrain, part of the farm credit system. We're a partnership between FCS America and their two partners, Frontier Farm Credit and Ag Country Farm Credit, and the other partner is American Ag Credit. So we cover most of the Central Plains with the exception of Oklahoma and Texas, and go clear to California and Hawaii to the west. So I've been in this role. My 3-year anniversary was last week. We're a new group. There's 10 of us in the group. We cover everything. I like to make a joke from A to W. I haven't found zebras or something that starts with Z yet that we cover as an economist team. I thought avocados were the first choice, but there's artichokes and other things in the portfolio that start with A. There's 2 of us that cover cattle and beef, myself and Don Close. He was our executive head for a while, and he's kind of working towards retirement. So he's my peer now as a senior research associate and economist. And then we cover on the animal protein side, beef, pork, chicken, a little bit of eggs. I try to stay out of the feathered friends as much as I can. And then we just recently took on a new economist, Matt Erickson, came out of the FCS America system to join us. He does macro kind of ag policy analysis, and then his family's swine breeders and hog producers. So he's taken on that pork role as well. I still focus a lot on kind of consumer demand for all the proteins, and then do a lot of work in the country as well. So that's kind of the current role. Previous to this, I was working at Express Markets, part of AgriStats, led a team of economists there, and we did protein analytics for beef, pork, chicken, turkeys, and eggs. Did price reporting on the chicken side, and then market forecasts and for prices and production, and then a lot of procurement consulting with retail grocery companies and chain restaurants in particular. I spent 9 years in the retail grocery business out on the East Coast. Jim, in your part of the world, you'll know the Food Lion stores. Worked with those guys and Hannaford Brothers in Maine and New England, and then the Sweet Bay grocery stores in Florida were part of that group. It was kind of previous to their merger with Royal Dutch Ahold, which is a big East Coast grocery company as well. Spent 2 years in the packing business, so I was a dirty packer for a little while. Worked at Swift & Company. That's how we got to Greeley, Colorado. it was a packing analytics role opportunity in Colorado. I'm a native of the state, didn't really want to move very bad. And that one kind of came down the pike and really kind of finished out my view of the supply chain. I made a joke one day when I was working at Califax at the time as director of research there that the one thing we just didn't understand very good was a packer. And because of their cooperative structure, there was 4 guys that couldn't be customers, and it was the 4 big packers. And I made this gripe one Friday afternoon at dinner after a couple of drinks. And my wife looked at me and said, well, maybe you should go solve that. Well, in the way things went in our marriage, it wasn't very long until I got a phone call and I got that opportunity to go learn the packing business and the pork business while I was there. Spent a couple of years doing that. And then was working at Califax at the time and I'd been there, 7 years, I think. A ruminant nutritionist by training. I had a little stint of dairy nutrition work in there as well. Colorado State graduate twice, animal science both times. I grew up on a cow-calf seed stock operation in southern Colorado. My dad jokes that the seed stock part was kind of an overgrown 4-H project. It turned out to be about 30% of the cows on the ranch when we went to college. Got a twin brother. Many of you probably recognize the voice, or if you see video, kind of look like him. And so the joke about I'm the better looking brother, he's a department head at Kansas State, livestock geneticist. Jim, you get to work with him probably a lot. And he was easy to talk to once. Mm-hmm. Now he kind of goes over my head. So we got to get even somehow. And as a result of that, though, I get to meet a lot of nice people at the Denver airport in particular. My kids always joke they can't take me anywhere. And there's a bet, like, how long will it take when you get to the airport before you meet somebody you know or knows Uncle Bob? So that's kind of our history. My family's ranch has been there since 1917. It's southwest of Pueblo. It was dryland wheat operation as well till the early 1980s. I'm not sure why my ancestors thought 6,400 feet of elevation was really good wheat country. It's not, except for about 1 year out of 10 that, you'd have a 50 or 60 bushel an acre crop where you could kind of compete for 1 year. And the rest of the years it was 20 to 30. So we got out of that. It's all back in native grass now. And mom and dad still have some cows. And mostly on lease program. So dad's pretty happy because those cows come back to the ranch for the summer. And then when it's calving time, they're somebody else's problem.
Good. I know when you and I first met, I knew Bob first and I was like, this is Bob, but not. And so
we've all done that. Don't worry about it.
Yeah. So they're identical twin brothers.
And
so.
I still send some folks like his way and make sure that they call him Dave.
Get your own back.
There's still some getting even 54 years later.
Great. So we're going to talk about markets and kind of what's happening in the market today, in the future, and maybe how we got here. So maybe that's where we should start. Sort of where are we and how do we get here?
Yeah. And Dave, probably before you dive in, it's let's be honest, it's July 25. So, we can't predict the future and never will, but it will be different. But I'd love to hear sort of the macro trends. Like you look at start at the consumer, sure, of how it goes from there. And then before we start getting into feeder prices, which hit all-time highs last week, let's maybe think about the macro ones first and we can debate cattle margins later.
Okay. So, yeah, sounds good. Yeah. Don't trade futures based on what I say because you're going to be late.
Yeah.
So let's get into that. Let's look into sort of what you look at with the markets and how you make your decisions.
Yeah. So how did we get here? Well, I think the best place to start, Ian, to your point, let's go to the consumer, the far end of the supply chain, and work our way back. And I like to take in this current role producers through that chain of thinking because the money in our business flows one direction and it flows from the consumer. There's no other source of money. By the time you get to the cow-calf guy, all those dollars have kind of churned their way through the system. It's kind of like Arkansas River water. If you're in Lamar, you're about 8 treatment plants below the headwaters. So it's kind of the same thing. It all rolls downhill. And that's a joke from my Southeast Colorado brethren. It really is the source of money. And I think when we think about the kind of macro supply chain, what's going on in the U.S. economy, it's a lot different than I think we think it is. Even I catch myself like falling into old habits of thinking this is the way the market works, or these rules of thumb should still apply. And the real challenge is beef spending has changed so much since the last cycle highs that most of us don't recognize the market for what it is and how it's changed. Part of what's going on is supply driven, but I did the math this morning at the hotel getting ready to come over here. I'm like, I should know what this number is. Because I think about it in our math, we do real per capita expenditure analysis on all the proteins. So when, as an economist, when we say real, those are deflated dollars. We use 2014 as our base on purpose because that was the last cycle high in cattle prices. So how has the business changed since then in terms of dollar value? Or the value of a dollar, that we got to get rid of that inflation noise. We've all felt it since COVID, what that does to our spending power, but what's it do we got to get that out of the price response, right? So we went and took all the per capita consumption. And I always remind folks at this point in the discussion, per capita consumption is not a measure of demand. It's simply a measure of supply because we calculate it by taking production, adding in imports, taking out exports, what changes in cold storage, what's left is the U.S. domestic supply of beef or pork or chicken, whatever we're talking about. And then we divide that by population. So there's no demand there at all. It's all about supply because it's really, I liken it to when I was in the grocery world, we had two choices on product. We could sell it or we could smell it. Right. If we could smell beef, we missed our opportunity. Even saving like the 50% manager special markdown, that was the emergency. Like, oh crap, we screwed up. We got to get this product out of here. And you did it with price. Well, that's the way we clear the market on, even if it's not smell it yet. But the market's got to find that clearing point. So one of our efforts is to try to find where that is and what dollars are going to take to move product, or what dollars can we generate with this pile of product. And depending on where we're at from a cattle cycle supply or production side, separate the cattle cycle into two pieces, the production piece and the price piece. Because there's a lag effect. Like as we change supplies, prices are always playing catch up. Or if you flip it around, sometimes they're leading the thing, right? Like when you're in the down part of the market, supplies are leading the crash. When you're in the up part, they're leading us up, but prices are what solve the problem on the cow side, right? The inspiration to keep heifers. So we're trying to always gauge where we're at in that price mix versus the production cycle. So in part of this analysis, we're working on that. But when we go back to that per capita number, since COVID, beef has just annihilated. And I'd like to use a softer word for that, but that's really what's happened, spending compared to pork and poultry. I mean, we've taken money out of their pockets for 2.5 years. Really, because we started the analysis because the question we got from farm credit customers when we go out in the country, we do a presentation on here's price expectations, here's what supplies are doing. They're like, when's 2015 going to happen? Everybody remembers the rocket rise we had and the crater that we created on the downside. And largely because most producers were still paying off those heifers that they retained in 2013, 2014. And that's, I think when we get to that part, we're going to have a discussion about where we're at retention wise. That's one of the problems with today's lack of expansion is those memories. So we'll get to that.
We know the best in the beef industry watch this show. So we want to hear from you. We'll pick one listener to win this exclusive Future of Beef Yeti cooler. Follow us on Facebook or Instagram, send us your guest ideas, or just drop us a message. We'd love to hear your thoughts.
But on the real per capita side, it takes pork and chicken spending combined to get close to beef spending per capita. So we look at it on a month-by-month basis. That's the narrowest data that we can get with monthly trade data. We can get daily production if we want it, but it's really the trade data piece that's the critical element here because we got to know how much we imported for the month and how much we exported for the month to get the real supply picture. Because we used to look at it from a domestic standpoint. Oh, you can get all kinds of jacked up in your math. And I see that a lot, especially trade publications. You shouldn't be around me when I read Twitter because we're making a lot of assumptions about what this week's production relates to price. And most all of those are flawed to some level, some worse than others. If we take the last couple of months, when we look at trade data, the changes we've seen in Brazil, Brazil's up more than 100% in shipments this year versus last year. If somebody says, hey, the ground beef market's long, short, whatever, I'm like, if you want to talk about May, I'll agree with you. We could have that discussion. If you're talking about this week, I don't think we have any idea what it is. And that's one of the challenges when we talk about tariffs coming forward. We've got all this extra noise in the marketplace going on as well that we're trying to extract and at least put it in a box. So spending wise, the beef side's fantastic. We get about $36. So we're about almost $4 ahead of pork and poultry combined now. So we've gained that $4 over the last 2.5 years. When I started this, it was pork and chicken combined equaled beef. And now we're $4 ahead, which is 12%. So 12% real per capita gain in spending. Producers look at me and kind of like y'all are like, well, what does that mean? It's about $84 more spending today per year per capita compared to that 2005 to 2015 timeframe. Spending was pretty flat there.
So what caused it? Is there a why?
Oh, there's a great why.
Okay.
And you're part of it.
All right.
And you're part of it, Jessica. When we look at beef quality and the way the product has changed since, think about the expansion we had in the 2010 to 14 timeframe. The cow herd went from 40% black-hided to 70 or 80% black-hided. And then the transition we've had in quality grade, days on feed, feeding period, all the things that make cattle higher grading have all coalesced to get where we're at today. And then you look at the outlets of where that product shows up.
Even, improvement in the last 3 years, right? The National Beef Quality Audit, 2022 was like 8.8%. Well, let's just say like 75% prime and choice combined, 75 to 76. Yep. Elanco benchmark data that's for the first quarter and a half of this year is 85% of heifers went choice and prime and 75% of steers went choice and prime. So the extended on average an additional 15 days on feed and genetic potential and push for it, and beef on dairy really upping our CAB, classification, et cetera. And it's just, we do not have a marbling problem in the United States. And so, consumers, and I think COVID too pushed it, right? Because TikTok came onto the marketplace. We've talked about this before. TikTok came on and people were cooking at home because of COVID. And they really started to learn how to cook beef and understand the flavor of beef. And what's even more interesting, I saw a stat the other day and I don't remember the exact numbers, but like my generation isn't saving money to buy a house. They're still spending it out buying high quality cuts of beef, but also paying for high quality cuts of beef at restaurants. So my generation is spending a tremendous amount of money at restaurants when you look back to like the last economic challenges of like 2015. And my generation was, well, not my generation, but the people who are of my age at that time were not spending at restaurants.
Right.
So we just have this huge appreciation for beef.
Yeah. And you go look at, we'll pick on prime.
Mm-hmm.
Pre-COVID, you couldn't buy a pound of prime beef in a Sam's Club or a Costco, let alone regular grocery stores.
Yes.
And now it's harder to find stores that don't carry either upper 2/3 or prime product. Well, versus, in the old days, you went hunting for it. Now it's hard to find a store that doesn't carry it.
The biggest discount retailers don't even stock Select really now.
Oh, it's because they got tired of getting sub-choice.
Yeah.
And creating all that. That's why the grocery company I worked for quit selling Select. It wasn't that we didn't have a market for it. So we couldn't get enough of it. And then backers were sub and choice into those Select orders. And then it created all kinds of confusion in the meat case.
Especially
because
on the
then
choice select
consumers couldn't
spread.
tell the difference between the product.
Do you think it's just that, or like, there's two other factors I always think about in terms of where we were 10 years ago. One of them was beef's always been a quality product. So for those of us that love it, it's always been quality. But it feels like now when you on social media, it's become a health product as well, where like 20 years ago, it wasn't a health product. Like even 10 years ago, it wasn't a health product in some of these instances, like certainly been attacked from all sides.
Right.
And then I think the other bit to that is I do feel ranchers and us as a supply chain have got better at communicating our story. Like
Absolutely.
we've got better at, being open, being transparent, not being defensive. Like I honestly feel there's been a huge change, and all of those have driven to much better consumer acceptance towards it being a healthy product to, not have 16 other products in it like we saw with some of the alternative proteins and stuff.
And it feels like we're in the first 6 months of the reinvigoration of tallow demand.
Yeah. I mean, you're looking young. You put it on your face.
I'm looking it doesn't help. It doesn't grow hair. I'll tell you that. But yeah, it's been amazing. I mean, you can go to I shop at Costco in Fort Collins, Colorado, and they sell a 3-pack of jars of tallow.
Yeah. Well, you see this, you look at the health, don't know what you call them now, but the biohackers, and they're, the seed oils is like out the window.
Yeah.
And so tallow is back on the market because it's seen as a healthy thing to cook with, where seed oils are seen as, now whether it's, I don't know how right and wrong, they'd kill me for saying that, but it certainly is a trend. Right?
It is. So, and you look at other things in the marketplace that are driving those things, the competition with seed oils, the health perception there. Then you go, look at the big, beautiful bill and the changes in 45Z tax credit, getting rid of the fraudulent used cooking oil, palm oil is what it is, coming out of Asia, out of the mix. We've doubled the value or the credit equivalent value of soybean oil to make renewable diesel fuel and sustainable aviation fuel. And most ranchers are like, why should I care about that? Well, tallow has a lower carbon score than soybean oil does. And so there's a lot of it getting sucked into.
Oh, that's why as cattle feeders 8 months ago, a year ago, we really couldn't price tallow in. Last June, July, we couldn't price it in because it's approved for biodiesel or biofuel. So we were feeding and doing research at the university on palm oils because it does not qualify for biodiesel. But, then the market shifts and now feeders can once again feed tallow and the market has shifted for that. So palm oil is pulled back out of the diets and so forth.
And it's going to turn over again.
Exactly.
And it's, you look at, I don't track tallow probably as close as I should, but I track 50 lean trim pretty close. And last week it was $2.42 a pound.
Yeah, it's amazing.
Almost triple what it was a year ago. And like quadruple or 5 times kind of normal long-term historic value. That's partly because of consumer demand for grinds. When I was in the packing business, the guy that priced chucks and rounds sat across the desk from me, and Friday afternoon was a very stressful day for him because all the boxed chuck and round product he didn't have sold got transferred to the grinding room for Monday's grind at the beef plant in Greeley, Colorado. And it cost him 35 cents a pound on chucks on sales realization. That's what his bonus was based on. For every pound that went down there. So his bonus, it didn't take very many boxes to his bonus to hit 0, and 40 cents on rounds.
Yeah.
So our joke was you can't add value grinding chucks and rounds.
Well, you can.
That is exactly wrong today. Like you go look at all of if you look at carcass from a carcass contribution standpoint, the dollars that chucks and rounds are contributing to carcass value today, since a month ago, we've taken chucks and rounds to be almost historic highs from a contribution standpoint.
You only need to look at your shelf on the grocery store and see the number of ground chucks there and how much money
or
it does.
how expensive a 90-10 is, or if you can even find it.
Yeah.
No, it comes from Australia. Anyway, that's a different topic.
Yeah.
But literally, Yeah,
I mean, we're down 17% on beef cow slaughter, down 17 or 18% on dairy cow slaughter year to date. We're just short of grinding material in the United States. And that's why Brazil's sending double what they've normally done, paying the tariff. Yeah. It's part of the new tariff structure that we're going to see on Brazil with 50+% tariffs on product coming, it's still not going to stop them.
Mm-hmm.
There's 60 cents a pound difference between imported 90s and domestic 90s.
Yeah.
And it's still going to come here. It has to, because we're rationing use with price in the United States today on grinds, on any lean point. Pick one. And then we complicate that by saying, hey, this is ground chuck or ground round, which consumers perceive as a higher quality grind, and charge them another 30 or 40 cents a pound. I think when I was in the grocery business, we paid 10 to get a source grind. So it was just regular trim coming off a chuck line or a round line, but we paid 10 cents a pound extra to get it segregated and called chuck trim or round trim. And then we put it at same lean point as, mid 70s for chucks and mid 80s, low 80s for rounds as what we were producing in our lean point percentage grinds. Same lean points, different name, and we charge 40 cents a pound more. And consumers would, you put them side by side, and they would buy the muscle grind. And then you hear consumers say, hey, there's this DNA test on this pound of ground beef, and it had 284 head in it. I'm like, surprised it's only 284 head. But that's just, it's a plant that killed 6,000 cattle in a day. How you not going to have that many in there?
It is amazing, like reflecting on it from being in the beef industry in Australia and the UK and here in America, like it is amazing how lucky that consumer demand you have for a premium product here. We don't have the same prime, choice, and select in Australia. We've got MSA grading, but consumers have no idea what's 1 and 6. So, but what it's managed to do for the beef industry and then the feeding industry that supports it, it's an incredible industry in terms of what you've done on a consumer demand.
Yeah. Jess brought up the beef quality audit, and I'm going to blow my CSU Carter State horn.
Oh, okay.
Just playing Nebraska.
Pop Dr. Belk's tires. It's fine. Go ahead.
That they did the first one. I think that was really the defining moment for the industry, because then the Blue Ribbon Commission came, and when we figured out that we had more than 20% of our choice steaks were bad eating experiences, that got people's attention.
Mm-hmm.
Like, what are we doing? And then when you went and looked at select steaks, and they were almost 60% bad eating experiences, it got people's attention. And so it was one of those, if you don't measure it, you can't manage it things.
Totally.
And once we figured out what the levers were and put the incentives in the right places, you saw grid and formula marketing take off, all the genomic.
But also I know COB has been a 30-year project, but that was, finding out the other day, that was started because they reduced select and reduced choice down another third, and they went, no, let's keep quality based on that research. And there's a lot to think about it.
Variation, right?
Yeah.
I think that's a critical one.
In the history of beef and pork packers, what's their real job? To sort the good ones from the bad ones. And they would do it on the rail.
The consumer uniform eating experience.
Yeah. And if we're going to make him sort them, he's going to get paid for it. And I think that's part of the supply chain story that's evolving today, is how do we make cattle more uniform from the cow-calf level all the way through the feed yard, so that more of them end up on the same rail on the same shift, and they're high quality, low variance in terms of outliers. How do you get that done? Yeah. And that's where the money is. And if you can hit those targets, I think there's reason to be part of these aligned supply chains. Yeah. Really, to probably jump further in the conversation, but that's really the driver today. If you're a cow-calf producer, this next 3 or 4 years is the time to figure out what part of this system you're going to be part of. Because when it turns over, the price spreads, I think, get really wide. Mm-hmm. And we all like to think about price spreads from $1 per hundredweight. Like if you think about the spread on steers and heifers on 4-weight calves, it's probably $35 or $40 a hundred. Well, we need to think about it either percentages or dollars per head.
Yep. And look, we're already seeing it. People who are part of our aligned supply chains, even in these markets, doing all right.
Because when the packer gets one head too many, the discounts are going to get bigger. Mm-hmm. We're not close to that yet.
No, we're very far
so should we break this back down to that?
Yeah. So ever wondered if you could be getting more out of your cattle?
Breeder is the first technology company that's able to track and optimize cattle from conception all the way to the rail. This puts the power of data into the hands of the rancher,
and enables them to improve their profit line quicker than they ever have before.
My decision to partner with Breeder was made largely after seeing a demo where I realized what Breeder's doing is unlike anyone else in our industry. Connecting the data from the packing plant back to the feedlot, the stocker backgrounders, and the cow-calf, even connecting that data to the purebred breeder, will just open the door to improvement at a scale and a speed that we have never seen in this industry before.
I believe Breeder's putting ranchers in the driver's seat. We can make breeding decisions based on large amounts of data very quickly. The calves that are produced, they have a higher cutout value, their ribeyes are more profitable, and it plays back to us.
As I'm out around the country, people are asking me about Breeder, and I always recommend Breeder. It's the tool for the future.
Head to breeder.co and book a demo with the team today. Well, and so in that 2014 to 16 kind of peak that we had, then the economists would say, well, it's really good, but you're going to see a lot more volatility. You're going to see a lot more volatility in the market. It's going to be up and down, and it just kind of went down. What help us understand or help producers understand why it's not going to do that again today? Is the volatility still there?
Well,
what's the difference?
I'm in the camp. It's still there.
Okay.
But it's going to be focused, if you look at volatility in total, it may not be a whole lot different on the average, but the outlying cattle, the good ones are going to bring percentages more, and the bad ones are going to be tens of percentages less, trying to dissuade that outlier.
Mm-hmm.
And I think those get piled up in bigger piles. And let's not fool anybody around the table or a listener. Like when we look at grid and formula premiums,
mm-hmm.
those aren't packer dollars you're getting. Those are other producer dollars. Packer cattle clean up, the grid and formula cattle clean up to the cash cattle within pennies, 100 weight. Not dollars 100 weight, pennies 100 weight. Packer buyers are good at what they do. And their incentive is to make the grid and formula cattle, or vice versa, whichever way you want to look at it, those two numbers on the average equal in the plant.
Mm-hmm.
That's the way their sales realization, when they start separating those boxes on the other end, math works, because then they got to get that back to what they paid for cattle. And
mm-hmm.
if they've got to sort them, that's how the math's got to work.
And I mean, when you look at what the grid premium is for a yield grade 1 or 2, it does not match the discount for a yield grade 4 or 5, right? Like they are making up a lot of money for having to pay a small amount for a yield grade 1 or 2 as a premium when you have a $17 per hundredweight discount on a yield grade 4 or 5, right? So I find that so fascinating when you look at the grid, what will pay.
And if packers were honest about what it costs them to fabricate a yield grade 4 or yield grade 5, it's a bigger number than that discount.
Mm-hmm.
They still can't get a big enough discount on them.
Mm-hmm.
Now, the math's going to change with if tallow's going to be worth $1 a pound. That math looks a lot different, but there's still a labor cost and a chain speed implication in the plant for those fat cattle. Not to mention all the corn that we're overfeeding. I mean, if we want to talk about sustainability, like that's the risk factor in our business is yield grade 4s and 5s. Because, I mean, when I was in nutrition school, fat had 2.25 times more calories than a pound of protein.
Yeah.
And muscle's only 25% protein, 20% protein.
Mm-hmm.
So just multiply that. That's 20 pounds or 20% more calories than we, it's more than that. It's 200 times more calories than we need to spend. Yeah.
Well, I mean, as an industry, we're obviously, on the feedlot side of things, there is no signal to our feedlot producers to slow down with days on feed or putting, you want to put as many pounds on that animal as you can.
It's incentive.
And exactly. And the reality of it is that those additional pounds at the very end of the feeding period are majority is fat. But the reality of it is that those animals, even fed 40 plus additional days, over 200 days on feed, way further to an endpoint than you normally would see. On average, 2.6 pounds per day live weight, 2.04 pounds per day hot carcass weight.
Yeah.
You want to talk about just literally feed for 10 more days and make 20 more pounds on your animal? Now multiply that by 350 in the beef or whatever number you want to pick.
Yeah.
It is complete incentive.
$50 bills.
We are well aware though that it is fat, but until, until the feedlot or the cost of corn becomes more expensive, then we will not see that.
Especially
shift.
with the cost of replacements, it's cheaper to feed something you've got than something to buy
Absolutely.
a replacement.
Oh, totally.
as well.
That's the math.
If you're a custom
and-
feed yard, you better be getting the yardage on that.
Yeah, the yardage, the markup on feed
Mhm.
per ton.
Yeah.
I mean, those really, when we think about the feeding business, there's two enterprises, and the cattle really aren't one of them. There's
No.
the yardage, the yard making
And the
money,
feed
and the
markup.
feed, and the feed mill.
Totally.
The cattle are just the tool, and
Mhm.
when the value of gain outpaces cost of gain by 2x or more, I think today it's probably 2.2.
Yep.
So we're at $1.20 to $1.40 value of gain versus cost of gain. I mean, cattle feeders they're pretty good at arithmetic, and that's easy math.
Yeah.
Mhm.
So if we bring it back to sort of the macro of the cattle cycle, where are we at? What's happening over the last 6 months? We talked just at the start, like we're starting to see some retention of heifers, but like it's pretty small, I would have thought, from what the indicators
It's
are.
really small. Yeah.
Yeah, and if we wanted to go buy futures, just
Yeah, I'm going to have another drink before we talk about that. So if we circle back there to the kind of the supply side where we're at, I've spent most of the summer on the road talking to farm credit customers and bankers and underwriters and trying to like intentionally seek out where herd expansion is going. If it's happening, it's not in our footprint, which would be the northern central plains, the Midwest, and the West. I think there's probably some going on in eastern Oklahoma and Texas. I mean, if we look at,
We've seen some in Texas.
some in
We've
Texas,
had more rains than we've had in 4 years.
yeah, and the trouble with the like January inventory report, and we just got Friday.
Yep.
The mid-year inventory report. It's a little complicated to look at because there was a year gap in there, so it's versus 2 years earlier. But in the January report, we saw expansion, and I trust the January inventory report way more than the July one because it's about 20 times more sample size. And it's still a survey, right? So it's not the gospel. We try to keep it consistent from a trend standpoint, and it's a good barometer. But to go say there's exactly 118,462,000 head, probably not the right tool to use. But in that data in January, Texas and Oklahoma were both bigger. We saw they were the two biggest growth states by number and percentage in the survey for beef cows. So they started growth. The trouble in the data was when we looked at the beef replacement heifers expected to calve in 2025 for Texas was too small to keep the cow number bigger on January 1, 2026, about 60,000 head too small.
Did the heifer on feed number in Texas change?
No, it didn't. Well, that one's hard to tell because it moves around a little bit. But the heifers expected to calve was small enough that I just called it kind of stabilize. I wouldn't call the Texas number actual real growth because it wasn't sustained growth because we didn't keep enough heifers. It was really a function of cutting cow slaughter the year prior in Texas, much of like what we're doing today in the rest of the country. Cow slaughter is down 18%. It's enough off of my earlier forecast in the year to say we've cut cow slaughter enough to stabilize numbers, and actually they would grow 200 and some thousand by the end of the year.
That's still way off.
It's a
true growth, though, isn't it?
It's like 0.2 or 0.3% increase for the year. And that's not sustainable growth because that's the one more year cow. That's that 2014 replacement heifer we spent way too much money on, or we felt like we did, that she finally had her highest price, highest profit calf in her life. And we're like, honey, if you can do it one more time, I'm going to give you a shot.
Yeah.
And there's a lot of those that would, in a normal market, would be a cull cow because there's, bad eyes, bad udders, bad attitudes, bad feet and legs. Prolapses. I mean, there's a lot of reasons that she should have gone on the truck, and she's going to get another shot or got another shot. And as a producer, the last calf a cow has mathematically is most likely her most profitable, especially in these heifers that we keep this year, next year, the year after, because they're the most expensive inventory of the price cycle. They have the highest carrying cost. They've got the highest capital outlay. They've got the highest opportunity cost, because what could we have done with those dollars if we'd done something else on the ranch with them? I grew up on a ranch. We were 100% contra cyclical. So when heifers were cheap, that's when my dad kept them. And our carrying cost of inventory on the ranch was lower than our neighbors because he always bought heifers on sale. Well, honestly, we didn't even keep ours. Most of the time we could buy better replacement heifers than we could raise. And it let the ranch stocking capacity be a little bit on the conservative side, and we could carry more producing cows that would actually generate revenue versus heifers. That's one of my biggest reasons why we're not doing much is when we go do the math on what retaining a heifer calf does to ranch economics. It's tough. It's a double whammy. We like to think of it only as either the cost side or the revenue side, and it's both. Like we reduce ranch revenue, keeping that heifer calf because we didn't sell her, which is especially problematic this year because
2 years.
They're the highest value heifers we'll ever sell or have ever had the opportunity to sell. And she's got the highest opportunity cost.
Yeah.
And cow costs are record high as well. So like there's not a lot of winning there. If you put a gun to my head, I'm like, I'm going to go buy a 4 to 7 year old cow. She's still the value. Or if you could find and we saw them here in the last month, $4,000 bred pairs.
Yeah. $5,000. I think we saw up in the north.
Yeah. In the north, there were some $5,000 ones. Those are it sounds like a lot of money, but that's 3 head. That's a cow already bred back and her.
Yeah.
When we went into it, I think it was an $1,800 to $2,000 calf. That's now a $2,500 calf in a month's time. Boy, she looks a lot more reasonably priced.
$5,000 can suddenly pencil at that point.
Yeah, those work. Yeah. Heck, even with where the price trajectory is going, and I encourage producers, like they say, well, should I pay for a bred heifer? I'm like, well, what's your net present value of her production? Well, then their eyes roll back in their head and they kind of convulse for a second. And they're like, it's like I just said basis to them, right? But what I'm trying to get them to do is like, we got to understand our cost, like real ranch cost. What's it cost me to do development, maintenance on that cow herd, run her year to year? That number's changed a lot. We want to admit it or not in the last 4 years. And I come from a lender, and I know what our interest rates have done. They've doubled. Yep. So that means if you're going to, whatever amount of money you're going to borrow to buy a bred heifer or a bred cow, that carrying cost just doubled, whatever the number is. And that's a hard number to get past, because if she's a $4,000 heifer, we might have changed ranch per calf margin by $200 for her lifetime or her 5-year production span. It's a lot of interest cost. And I think it's gotten guys like, I'm maybe better off in, this is what I advise folks to do, is like, what's it really do to you not to expand? Well, the opportunity cost is you're going to sell,
the calf
calves, more heads of calves 3 years from now, but what's your balance sheet do? And that's the other thing going on. I think there's a lot of ranches that just got done with the last drought and finally got a hay crop and got some hay in the yard. And instead of 1 year, they want 2 years of hay sitting around. That's costing money. How do we fix that ranch level economics? It's sell heifer calves, because the bull calves / steer calves, they go to market every year. It's what we do with those 20% of heifers that makes the difference on where this thing's going to land. And I'm in the mode of keep your powder dry. Like you can fix your balance sheet in a year.
Well, it's interesting then you look at like 2014 versus today, and that's a big difference. If we look at supply, we're not getting 50-50 trim and prime and choice out of these import markets, and that's where the demand is. So you piece that all together, there's still a huge demand for American beef.
Absolutely.
Right? And we're not replacing the heifers as fast as we can. Does that mean this cycle just continues to grow for 2 or 3 years? I mean, again, don't bet on what we say, but it does feel that way. Like
if we look historically, that's right, Ian. we've got about between 30 and 36 months from when we actually start heifer retention before prices turn over. So that's kind of the biologic lag, for lack of a better term. By the time we breed a cow or breed a heifer, calve her, raise her calf, get it through the feed yard, get it through the packing plant, that's about 36 months. And for most of us, we get to make that decision once a year. And 70+% of ranches make that decision in the fall. And we didn't do it last year, so we've got a chance. We're like knocking on the door here in the middle of the summer and looking down the road to see what's going to happen. I think a lot of guys are looking around at what their forage condition is and what the weather is. I make a habit of going through all the, not just the local weather guy, but the broader view climate guys that are, going to talk about El Nino or La Nina or neutral phase. Where are we at? El Nino's almost gone. We're kind of atmospherically sounds like, and I'm not a weather guy. I don't read this into it. I stayed at a Holiday Inn Express last night and read a lot of them. It looks like we're kind of in neutral phase and we're waiting for the climate to catch up with the ocean, or the atmosphere to catch up with the ocean. And historically we don't go from La Nina or El Nino to neutral back to El Nino. That's not how it works. Yeah. And where we're at in this, 20 to 40 year cycle of the Atlantic Ocean, the Pacific wants to be in La Nina phase. And that's why we had the 5-year drought in Western Kansas. Most people want to call it a 4-year drought. It covered 5 calendar years. And there's a predominance of those La Nina events being longer than El Ninos on average anyway. And then there's, greater likelihood we stack them together. Well, I think in my working with cow-calf producers, the ones that tend to succeed are the ones that ranch like it's a drought all the time. Yeah. If they got extra grass, they go find some stocker cattle or whatever, but they keep the ranch and the cow herd appropriately sized. And I think we've learned a lot about mature cow size in the last 5 years of drought. Yeah. And they're not what they were. If it was a 600 cow ranch in 2005, it's not a 600 cow ranch today. It's probably 540 or 550 if we're lucky. Yeah. And how do you manage that constant number of cows and then what are you trying to grow to? You can't go back to 600. You got to just keep enough heifers to either meet your replacement rate or maximize the number of cows you can, running age cows, producing cows on the ranch, and go buy replacements.
So now that a lot of cow-calf guys are excited and you've depressed a lot of packers.
They're easier to depress.
No, but on a serious note, when we think about this, like what, it does look like long-term, all things being equal, that, we're going to continue to see more peaks next year than what we've seen even this year. And, we've seen some pretty huge prices over the last week, let alone, the last few months. What are the black swan events? Like what's going to give us a curveball?
Could derail it.
Derail it.
What's the thing? And that's part of the challenge with the definition of black swans, or those are the real curveballs. There's the things.
It's the fires in a Tyson plant that we have.
The things we think we don't know, and there's just things we don't even think about.
Where are the risks?
Yeah. I think consumer demand is one. Like if the economy really took a nosedive, which I don't think is coming. But it would be a significant setback. And it would have to be huge, because in the beginning of this, we started talking about that real per capita expenditure and how much it's grown. I said $84 a head or
per person
per year. That's on 340 million Americans. We only slaughter about 30 million head of cattle a year. Divide that out. It's about $1,200 per slaughter animal, more value today than we had in the 2005 to 2010 or 11 timeframe.
I have a question that you might not know the answer to. So like today's intake for every American, if you divided all the beef in this country, is like 56 to 57 pounds.
Yeah, we're a little smaller than that this year. We'll be about 53 and a half. But yeah.
And what would have that looked like? Like, let's say back in 2012 or 13, or maybe you don't know
It was
that
like
year, but
59,
okay.
58, 59. It wasn't a lot bigger. We've lost about 4 pounds in the transition. But that's not all.
But too premium, right?
Yeah. And it's only been that, like, if we just looked at domestic production, it probably would have been double that decline, but we offset it with imports for grinding materials. So, I know there's a lot of producers out there that don't like to talk about imported product. It built the demand base we've got for consumers. And, that's one thing that I always kind of ping our producers with when we start talking about, customer stuff. There's 2 different beef customers for most retail grocery stores, at least all the ones I consulted with, the one I worked in directly and then consulted with. If they really get honest with what their shopper card data says, there's about half of their beef customers that are only ground beef customers. Mm-hmm. And that surprises a lot of producers. But on the flip side, the biggest pile of anything that comes out of a beef carcass, fed cattle carcass, is trim. And it's 50 lean trim first. Mm-hmm. So we got to have a place to go with that. Or like if we start enjoying $2.42 50 lean trim, which we are today, and we start thinking that's normal, and we go back to 75 cents, $1 a pound for 50 lean trim, those are hundreds of dollars a head that comes out of the equation, and it could happen overnight. That's one thing that scares me is, something ground beef wise goes wrong and it's blamed on.
There's nothing greater than seeing your cattle grazing on lush green pasture. Oh yeah, and nothing ruins that view like weeds and brush soaking up all the moisture and nutrients. Regardless of precipitation, we have to take care of our pastures. It doesn't rain grass.
The passion for cattle ranching starts early. So should the protection. Let's keep our pastures in good hands with Corteva Agriscience. To learn more, visit rangeandpasture.com.
Probably imported trim or something, and consumers step away from ground beef. We've got more dollars tied up in ground beef expectations for the industry than we ever have. And it's not just cull cow values, which most of these cull cows are worth more today in a hamburger bun than they were as a beef replacement heifer. So trade-in value is high. That's the other thing that I think has driven slaughter even to keep up at down 18%, is because if I'm going to go buy a $4,000 replacement heifer and I can get $2,000 for the cow that's leaving the herd, that $2,000 upcharge doesn't feel as bad. Rightfully so. It's kind of historically normal on a percentage basis, so they don't look so bad. But back to your question, Ian, like what's the risk? Something that happens in that $1,200 of extra value for the consumer side.
Yeah, and that could be a gradual process of prices getting too high for people to afford it. But it's probably more, as you say, like trim prices coming off.
I don't think those are surprises though, because I mean, as an economist, we think about how do we ration use, or how do we provide for accounting for best use of a product. We're going to ration use with price. Yeah. Let's not make any mistakes about what's coming. We're going to price some consumers out of our product.
Yeah, but most people thought we were going to price them out a lot faster than we have.
I think average retail prices are $8.40 now.
Yeah, and we thought at $6,
and we thought it was going to happen at $6. Exactly. Well, I think we're at $9 by the end of the year, and I don't really feel like we're asking too much, because if we go look at, we've done a whole lot of like consumer metrics, like what things matter. Like, is it credit card debt? Is it car loan defaults? One of the best things, average, like take the all fresh or choice retail beef price, I don't care which one you use, against average hourly wage. And if you look at it in buckets, because beef's very seasonal in terms of demand, look at it in monthly buckets. So take June or May or whatever. Average retail price and average hourly wages have about a 96% R squared.
Wow.
Like I took more stats classes in grad school than anything else. And that makes me smile every time I look at it. I'm like, that, I don't know which one's causing which. But the math, they're very strongly correlated.
Yeah.
And as long as we're on that train, we're probably okay.
Yeah.
It's something that, to your point, if we start rationing use and pricing some consumers out, the total pile of dollars probably hasn't changed very much. We're probably going to get, instead of $36 per month per capita on a real basis, we may get to 40 in this cycle. The total dollars that we extract out of the industry is about the same. If we look at this year versus 2005 to 10 kind of territory, we're getting about $43 billion more for cattle and beef products than we did.
Wow.
Now, the cow-calf guys are going to say, hey, I'm not getting my share. Actually,
They are.
you're getting $400 more than your share today from consumer demand. And it shows up. If we go look at the margins above the cow-calf guy.
They may have said that last year. I'm not sure they're saying that this year. They're doing all right.
No, I just used this year's number. Yeah. It's real. There's a lot more dollars in the system, but to Jim, your point, there's more risk too. Like, how do we manage to make the most of the opportunity that's in front of us? Some of our producer friends are going to say, well, I need more cows. Others are going to say, well, I need less debt, or I need more land, or there's a lot of constraints out in the system that every operation is trying to adjust to, and net, it's led to a whole lot of nothing happening.
So we talked about the risks, but maybe let's talk about the opportunities. I mean, what kind of gets you excited?
Well, there's a lot of exciting things going on in the industry, and you look at, as high as costs are, I look at the transition we've made in terms of price levels. If you go back and look at, long-term futures charts, we kind of tend to trade in channels over time. Or if you look at the 5-area fed cattle price, tends to be channelized. And when you go to a new level, like we did in 2020, the old highs become support for the new lows. And we've done a lot of that all the way through the system. So if we go back and look at, just for perspective, that pre-2015 time frame, 2010 to 15 or 2005 to 15, it's all about the same. We compared to now, we've doubled fed cattle prices, doubled calf prices. We've added $100 a hundredweight to the box beef cutout, and we've got these new kind of established levels set. I look at those, and that historically they tend to hold unless we get like ginormous things. Like even the 2008 financial crisis, it really just took us from what we were at right before it, cycle highs, to cycle lows, but we didn't break new ground to the low side. And then we bounced back, and then we got to 2015 after 2014. So 2014, we go to new highs. 2015 was a 60-some% retracement of that. And we kind of established some new lows in there, and then went back 2020, come back. If you throw out the absolute peaks in some of those, we've got some new trading ranges that I think work for the system. So I like to think of things as the kind of in total, like stacked bars of prices or per head values as you go through the system. Or if you want to look at it from a margin standpoint, there's enough dollars now between cow-calf producers and consumers that if we took a more socialist approach, not that I'm advocating this, but if we just kind of peanut buttered those margins at historical kind of percentages, everybody would be pretty happy.
Or standard deviations from the
mean. There are standard deviations from the mean.
Yeah.
I mean, I like to talk about mean reversion. Those are good things to look at. Like, go look at where that has taken us to. If you've got cow costs that are in the average of, and I'm going to revert back to my old standardized performance analysis work, which is very detailed accounting at the cow-calf level. Not enough producers ever did it, and a lot of them did it. And it was a hard piece of work. But what they figured out is that if I'm a low-cost producer, I didn't say low performance or low productivity, because the low-cost guys outperformed on average the high-cost guys in terms of pounds weaned per cow exposed and the really important ranch metrics. It's the guys that had the focus on cost that made money 7 out of 10 years in the cycle, instead of the average of the high-cost guys that made money 3 out of 10 years of the cycle. So, like, if you've got a choice, you want to be average or below average cost. I'd say you want to be the average of the bottom third. If you can ranch at that level, your sustainability, if we're going to talk about the financial metrics of sustainability, you've got a lot better chance of making your operation a generational kind of operation or multi-generation operation. If you're in the high cost end, you absolutely have to have all the data and all the tags you can hang on an animal to extract the maximum amount of value. Because if you don't, if you just sell them as commodities, you're in trouble. And it sounds like a downer kind of a thing, but that's what gets me excited, because there's a lot of producers out there that are still in this commodity mindset, and they're not raising commodity cattle. They're raising the top 25 or 30% of animals in the system, and they're letting that value get propagated through the system. And I kind of feel like it's the job of the four of us and our peers around the table to help get that guy in the right part of the supply chain so he can maximize the revenue there.
I agree.
Because it is absolutely paramount. The other thing I hang with that is, and it's hard to get people excited about risk management until the ship's up on the rocks, right? Till the Exxon Valdez is broadside to the shore and leaking oil, nobody gets really excited, and they say, well, I wish I could do this and I should have done it yesterday. Well, there's no reason with potentially record margins. Like if you've been able to manage cost over time and you've got this year that's a record revenue year, I think we all ought to take a chunk of that. And it's not a very fun chunk, but it's $40 to $70 a head. Set that aside, and that's our risk management bucket. And I don't care how you do it. If you use LRP, futures, options, combination of it, whatever it is, as cow-calf producers, we got to get better in the next 3 years at managing risk. And I change it around for them. I'm like, you need to manage your equity. Like, how much of this nest egg that I've put together am I willing to put on the table? Like, go to Vegas. Most of us walk around all in, and we don't have to.
Well, we're seeing people buy cattle now based on the profits of the ones they just sold. And it's like, that scares the hell out of me, right? So
it does. And they don't have a marketing plan for those cattle. They don't have them tied to any kind of cost structure.
I don't know if they did a full break even or not. One of the components, the cost of the animal, fit into the break even.
Like how much corn are we going to give away for free?
Yeah.
So there's some of that. So I get excited when I get people's attention to say, risk management isn't all or nothing. There's a continuum of like how much and how aggressive do we need to be. So from 0 to 100% coverage, and then what tool are we going to use to do it? There's a bunch of options. Part of it's dependent on what my cost structure is on my ranch. So I got to have all that work done. I got to have my marketing and merchandising plan done, because if I go, don't do that, and I go and put a risk management plan in place, I just bought a marketing plan.
Yeah.
Like regardless of what I thought I was going to do, if I say I'm going to do LRP and it's this date, I've just changed my marketing plan. So we got to get all those pieces aligned and working down the stream. So it excites me that producers have an opportunity here the next 2 or 3 years to really sit down and say, this is my business plan. This is my risk management equity plan. How do I manage this? How do I get, and a friend of mine reminded me the other day, it was Jason Kraft. He was on Matt Perrier's Practically Ranching podcast, and I've been using the crap out of it since. How do I get less long? Every cattle producer, every cow-calf guy is long the market.
Yeah.
How does he get less long and leave opportunity for the upside? That's his challenge. That's what I view as a big part of my job, is helping those producers look down the road 2, 5, 10 years. We know what cattle cycles do, pretty well documented. We can fairly accurately predict. I hate point forecasts for a price forecast. I'd rather give you a confidence interval of it should be between these two guardrails.
Yeah.
What happens if it's the high side? Great. I'd rather you budget it on the low side. And if it works better than that, great. If it doesn't, you're not calling and cussing at me because I was too low. So don't just take a guy's annual average calf price figure out what the bandwidth is on it and do some sensitivity analysis on your ranch to say, what if this happens? Everybody's got liability insurance on their ranch pickup, largely because the thing's not worth very much, but it's a greater risk to the operation if
it doesn't work.
One of us or the hired man or somebody's driving it and something traumatic happens. We don't want to lose the ranch over it. And that's why we have liability insurance. Well, that's the kind of risk coverage we need on the revenue stream on the ranch.
So all that sounds nice, but how does how would a producer listening today or watching today, how does he get started with that? Does he go to his banker? Where does he go? Go to his extension agent? Where does he go to help with that plan or to help manage his risk?
There's nothing greater than seeing your cattle grazing on lush green pasture. Oh yeah, and nothing ruins that view like weeds and brush soaking up all the moisture and nutrients. Regardless of precipitation, we have to take care of our pastures. It doesn't rain grass.
The passion for cattle ranching starts early. So should the protection. Let's keep our pastures in good hands with Corteva Agriscience. To learn more, visit rangeandpasture.com.
Well, I think it's probably a function of quite a few of those. And depending on what size your ranch is or where you go, it probably varies a little bit. If you've got some, I don't want to call it disposable income because it's not wasted money. But if you've got some money to invest in that kind of service, there's great ranch consultants out there that will sit down with you and help you at least lay out the steps you need to achieve to get through that. There's great tools out there. Like if you want to do net present value of a female, you can go to Colorado State, Kansas State, Nebraska, and Iowa. All have net present value heifer calculators on there. Most producers will open that and say, well, I still don't have all the pieces. I got the thing that does the math, but what are you missing? You're missing cost. You got to put your cost to develop that heifer in there. So you got to have some reasonable estimate of that, reasonably accurate estimate of that. You got to have some estimate of future value of her progeny. Call me. I can help you with that. Mm-hmm. Will it be right? I'll guarantee it's not. I mean, it's kind of like concrete, right? It's guaranteed to crack and it's warranted against theft. This is probably not better than that, but I'll get the right shape on it. You can pick the level we start at, or I'll help you pick that number, and we'll put the normal cyclical kind of plunge off the cliff in 4 or 5 years, whatever it is, and get the right shape to that. And then we can look at what that does to the value of this heifer and help you make those decisions. If you want to look at where you're at from a cost accounting standpoint, there's some kind of basic spreadsheets that would at least get you the right buckets through extension. I think all the unit extension services and economists from most land grant states would be able to point you to those places. The thing I find most valuable in some of those discussions isn't really getting the math done. It's like, where do I stack up from a benchmark standpoint? Mm-hmm. And that's really, really hard because there's not very much of that data in cow-calf production. Like, where do I rank on cow cost or feed cost? And that was the beauty of that old SPA analysis. That some of that data is still out there. Kansas still does some level of that to get an idea of where your opportunity is. Like, you may be the cheapest guy on hay, but maybe your reproductive performance isn't up to snuff, or like help somebody from the outside help point a light on where you most desperately need to improve. Mm-hmm. The coffee shop isn't it.
Well, we're seeing a lot of, that's what it's helped our growth. It's like, people are seeing this as an opportunity to invest in measurement. People are investing in genomics. Yeah. There's a lot of things which people have had a bit of profit and they're like, okay, how do I set myself up for the future?
And that's one of the things I've enjoyed listening to on the podcast is really that focus on individual animal management. Because if you're a 600 cow ranch, there's 60 cull cows on average every year. Mm-hmm.
And how are you calling?
And how are you
going to do it? Yeah. Like most of us get forced into picking by bad eyes, bad udders, and bad attitudes.
Yeah, it looks at me funny.
Yeah. But some of those cows that get on the truck might have had one more calf in her, and we've been better off gambling on her. Literally
had the calf in her on the truck. Just kidding.
Yeah. No. I've
I've seen those.
Yeah, I've been the guy prey checking and done that. That's why I got fired by my father. But it was his favorite cow. It was only one, but yeah, it was his favorite cow, and she was bred, but she didn't have a tooth in her head either. But there's some of that kind of stuff that, if we put just a little bit of investment or time into it, and that's the other thing. Like, and it's something my dad preached as a kid, and I didn't recognize it for what it was. Most people nowadays have probably heard of Robert Kiyosaki, and that's what my dad was telling us. There's working in the business and working on the business. And as young boys, my dad he was an older guy, and he had a Royal branded adding machine. It was a big blue thing, and it had the blue little digital numbers that were individual light bulb tubes. I mean, it was the 1979 version.
You're literally looking at me like I know what this would be.
Like, some people were like, oh, every ranch had one of those. We thought it was cool because on Sunday nights was bookkeeping night at the ranch. He had this big ledger, and like everything was on paper, but he was good about putting it on paper. And we thought it was cool because we'd go run the adding machine for him. And our grandfather was an accountant and controller for the Pueblo Water Works, and he could look at a teller's ledger for the day and add it up in his head and tell at the bottom of the page if they were right or wrong. Wow. And if they were wrong, by the dollars and cents that it was. And so my dad was pretty good at math, and we'd be sitting there running the thing, and the little ticker tape would be coming out, and we thought it was cool because it made a neat noise. And we'd get to the end, and he'd look at it, and he'd look at us, and you better do that again. But what it was he was working on the business. Like, he knew what changes were going to be made in the next weeks and months to either get back on budget or get something improved to hit that. So yeah, have a budget, have a grasp of what expenses are, have an idea what revenue's coming, that cash flow projection. Those are some of the hardest things on ranches to get put together, because some of us don't have a marketing plan outside of, I'm going to send them to the sale barn on the second week of October, come hell or high water. And if you're listening around, that might not be the right plan. It may be, it may not. It depends on who you are and what you're doing. So just being active in the business over the next 3 years, I think is paramount. Like, we got to get everybody on the board, on the ship, on board, and headed the same direction. Because one of these days we're going to produce one too many. Yeah. And then the wheels start to come off, and the cracks start to show up, and the prices start to decline. And then we go through 4 or 5 years of finger pointing and all these things that distract us from what the real opportunity is. And it's figuring out which cows and which sire lines need to get out of the herd, which animal health products are worth the ROI that the investment we're putting in, what feeding and nutrition program works, what we're doing from a grazing management standpoint, there's.
You can still pay your subscription to the breeder.
Absolutely. Which is I think the conduit to your point is like, how do you connect all these pieces together? And that's one of the ways to do it. Yep. And I think has a lot of value through the supply chain and helps align you with maybe potential places and alternatives on ways to market cattle.
I think that's the exciting part, is like we're seeing what beef spend has done to the shopping cart. And you'll speak to these retailers now, and they're like, beef is our driver of shopping cart spend. Some of them will even stand up and say, I don't care if I make money on beef. Now, I'm sure they're doing it right, but like, it drives everything else in the store. Absolutely. And what that's doing is bringing so much awareness to where these cows come from. The people doing the good job, when that market turns, they're going to be the ones that are, standing there very happy because they've got an outlet for those cattle.
And you may not, when we get there, you might not feel like you're getting a lot more value out of it until you look at your former peer that's getting a whole lot less. Yeah. I mean, the risk of, I think the risk of greater discounts on the outlying cattle is bigger premiums on the premium cattle.
Mm-hmm. Well, we've already seen it with prime spreads over the last while. They've gone out and out and out. Like,
it's the carrot or the stick.
Yeah,
we get to pick.
Very good. Well, we could talk a lot more things that could go wrong, but it's been quite nice to talk about things that could go right.
Right.
So,
And I like to remember when I was a kid, we always got excited when there was an old guy that was a market reporter named Evan Slack.
Yeah.
And every producer that's 50 years old or older knows what it is. And he'd get on the market report, especially when, things were going good. And he had a quote. It was higher, higher, higher. And that's how he'd start his segment. Like he didn't say, "Hi, this is Evan Slack. I'm reporting from Winter Livestock in La Junta, Colorado." He started with his trademark. If it was a higher week on the market, that's how he started. And I'm starting to feel like that kind of over the last month, or every video sale we go to or listen to. The market's been a bit of a challenge to forecast. And one of the things we talked about maybe as topics for the meeting was like, what's the contrarian view out there? And, we started the year, our group, probably the leader of the pack in terms of price forecast.
Yeah, you were. I remember this time last year, you're like, it's going to be big.
We got it out there and kind of on time with the rest of the outlooks and started looking around, and we were like $15 ahead of everybody. And we were still $30 wrong. And when we looked at the year, it really broke down into, it was really a tale of two halves. Like the first half of the year was kind of traditionally bounded by supply and demand. And the back end of the year, the wheels didn't necessarily come off. They just started spinning a lot faster because we got to the point where we really started rationing use with price. And I think that's what's going on. We're chasing after feeder cattle and calves from a feeding segment because we're 500,000 head short from Mexico so far year to date. That's all the reduction in placements.
And that doesn't look like it's opening up anytime soon.
And it's not going to change.
Right.
No, that deal's, they say month to month. I wouldn't be surprised if we sat down this same day in 2026 if we've gotten any feeder cattle and calves from Mexico.
Yeah, I'd agree.
I'm pretty not optimistic. I don't want to say bearish because that's the wrong term for it, but I don't think we get any. And that's a real challenge. And I get asked a lot in the country, what does that mean for prices for feeder cattle, for example? Domestically, if I go build a multiple regression model to forecast feeder cattle or calf prices, feeder cattle and calf supplies outside of feed yards is like a distant number 3 driver of feeder cattle prices. We all know what number 1 is: fat cattle prices, or the futures of expectation, the back end of the board, and corn price. And they are 5 and 8 times more impactful to the model than the number of feeder cattle and calves outside of feed yards. It's like 50 cents a hundredweight different if we get 1 million or not. It doesn't matter in terms of price for the national average. But if you're a South Texas feed yard, it matters a lot because now you've got to turn 180 degrees instead of looking at those Mexican feeder cattle and calves that are acclimated, work in your system, you know how they feed, and you turn north and you say, oh,
yeah, the basis up here is crazy.
Yeah, I got to go to South Dakota and buy cattle away from a grain farmer, put him on a truck for 600 or 800 miles, put him in 30-degree hotter weather and 40% more humidity, and predict how he's going to perform. Yeah. I don't know either. It scares the crap out of me for those guys because it's going to be a very difficult transition and it's going to take a while.
Yeah, and that's where we've seen beef on dairy get to $1,400 day old calves.
Yeah, there's another place where I was $400 off.
Yeah, so those dairymen, they were a byproduct, and now they're core profit driver now.
And if you think about outside of all the other obvious advantages of beef on dairies for dairy farmers, $1,400 of revenue on a byproduct calf that's now 55 or 60% of its production.
Yeah.
It's a huge revenue driver on a dairy farm and a decision point now that he takes seriously. Those are all great things. The greatest thing is he can't grow either.
Yeah.
Like they're in the same bind that we are as cow-calf producers in the beef business. He's got essentially 2 breeding decisions already made in utero and no way to make more heifers. He can't work himself out of business. The old days, dairy farmers had half the calf crop was always heifers, and he only needed 30%, 35% of them. He had a 15% swing. Any given day, he decided to keep more heifers. He had 15% more to do it with. And 18 months later, guess what happens? Dairy market's a wreck. We're back at $12 or $14 milk instead of 20, and he can't do that today.
No. Well, and then the last one is grain. You know, you look at the corn price and grain price and everything like that, and you know, it's continued to be favorable for the cattle feeder. You know, do you think there's a chance of things like, you know, the ethanol subsidies being cancelled and that'll further drive it down? Or do you think it could go the other way? Because to your point, you know, corn price goes back up. We're not feeding as many heavy cattle anymore. The amount of weight of carcass that goes in is going to reduce. There's going to be a lot of things that will happen if that corn price goes back up.
Yeah. And, you know, the weight challenge is probably one of the last things to change if we think about carcass weights, because we think about how cattle feeders price feeder cattle. Yeah. The back end of the board minus feed cost.
Yeah, and they've hedged the corn anyway.
They just bid it right into upfront costs on the cattle. So it takes a while for grain to really, like 2 turns of cattle for grain to catch up with cattle prices.
Yeah.
On the flip side, like if it goes lower, that shows up immediately because we just put more days in them like right away.
Straight away.
That value of gain, cost of gain equation like kicks in today, and we just keep feeding more of them. And in the current environment, I don't blame guys. I mean, we're not going to fill like all the feed yards. They're going to give up a lot of margin trying to stay full. I think every feed yard today's gone back and done the math and said, what's the minimum capacity I can live with? And maybe I ought to just focus on doing that really good at that level and kind of ride this out instead of trying to blow my brains out on, you know, the old equation was, you know, empty pens make no money. Empty pens only lose so much money. Yeah. And we know what that number is, and it's not $600.
Also, the credit lines they have, which you'd know aware, aren't covering the replacement. You know, what bought 200 a pen of cattle last year buys half a pen of cattle this year.
And that's a real fear, I think, within the lending community and feed yard owners and managers is when the market turns over and the borrowing base contracts.
In the beef business, every decision counts. Drovers delivers the expert analysis, market updates, and real-world reporting that cattle producers rely on to make smart, profitable decisions. From market updates to policy shifts and animal health, Drovers delivers expert reporting and real-world analysis that helps producers stay ahead. With a mission to help beef producers become more profitable, every story is built around what matters most to the cattle industry. Get informed. Get Drovers.
That next round of cattle gets small fast because we've done all the line extensions. We've leveraged this thing kind of as far as you can, unless cattle, I mean, in the current environment, borrowing bases maybe got one more chance to go up and expand. As soon as it starts to get smaller, the thing just turns into a domino and gets smaller quicker. And that's probably a watch out. Yeah. I think if we were putting together a list of like, what things am I watching for? Heifers as percent of feed yard placements and on feed. It's okay. The trouble with the on feed numbers, it's only quarterly. Placement number Cattle Facts does. It comes out weekly, monthly. It's okay. They tend to move around more than I think probably steers in the inventory do. Heifers as percent of fed slaughter. That one's great because the USDA's, we can throw rocks at them for not being right or wrong or whatever. They're official, but the guys at the plant can count steers and heifers. Yeah. Really good. That number is accurate, and it's not showing any signs of heifer retention at all yet. And that's particularly important if you look at this July to August or June to August timeframe, because if you were looking at the earliest heifers that would have been retained last fall's calf crop, when they should be getting dead today. And they're showing up in the fed slaughter. The on-feed number's down about 1.5%, but it's still 2% away from any kind of expansionary, like normal benchmark. Like we're in expansion when heifers as a percent of feedlot placement or heifers as a percent of on-feed is, 36% or less. We're still 2% away from that. Now we can go argue there's some beef on dairy flux in there that might be 1% of it, but even worst case, it's 1% away. It's enough for me to say we're not there yet. And so those are things I'm watching to say, hey, when's the clock start to tick for that 30 or 36 months? Maybe this fall.
Maybe.
I don't know. I don't see a lot of activity. I see a lot of replacement heifers, or folks saying, I'm going to retain some heifers, maybe breed some for the neighbors or whatever. But we've done that the last 2 years. And sometime between January 1st and the end of February, they're all in feed yards. Yeah. Because instead of making 2 years ago, it was $100 and they made $400. Last year, they wanted to make $200 or $300 and they made $600. How many guys go out and try and do that again?
Yeah, they got to do it again.
You can't go broke paying taxes. It's really hard. And that's, those guys looked at it and said, I might be short grass. Don't like the grain price. I'm going to take the money. And so we're going to, sometime between now and February, we're going to have an idea of if herd expansion is starting or not.
And so we kind of started at the beginning talking about, dollar spend per capita and stuff like that. What happens if the economy gets better?
If it gets better?
Yeah.
That's an optimist. Yeah. Prices go up. And honestly, in my forecast, I don't have any, I don't think we get stagflation. I think the Fed has probably been right with higher for longer. We may have had an opportunity at a change in rates late spring, maybe early this fall. I think the whole tariff noise has got the chairman kind of on, I wouldn't say on his heels, but very cautious, because tariffs in the near term, in the short term, look like inflation to the marketplace, to consumers. It's tax on consumption. And he's trying to separate out what part of the tariff is what he sees in the CPI versus what's true inflation drivers out there. And if the 1980s taught us anything, is err very, very cautiously on being on the wrong side of that. Because if you get stagflation, that's a whole different level of hurt that none of us want to go back through, especially in agriculture. And that's a combination of stagnant productivity on a nationwide GDP scale and rising prices. So we're not getting any response on productivity with higher prices, which is what the market should do. If we see prices go up, consumers are willing to pay more for the same amount of goods. Eventually, we should make more goods. That's what happened in the 1980s. Prices went up.
Yeah.
The thing that didn't happen is we didn't produce anymore. We contracted a lot. And so he's really cautious about getting us in that place, and I don't blame him. I don't think we get there. I think you look at the other things that were going on at the time. We had energy problems. We're pretty much energy independent today. So we don't have to worry about that. We might not like gas prices at $2.50 to $3. We've all learned to live with it. I think, that not $6 like our friends in California get to pay once in a while for the rest of the country, or Hawaii, does spending pretty good. Because if people aren't having to spend money on gas, historically they're spending money on groceries.
Yeah.
So,
well, and we haven't seen the true impact of the AI innovation yet in terms of productivity.
Oh yeah,
it's going to come. There's no doubt. Artificial intelligence again this time, not insemination. But I think it's going to be really interesting. Now, that's not going to be robots on ranches, but that's in 90% of the industry. There's a lot of opportunity there for productivity gains.
Yeah.
So Dave, appreciate you coming to be with us today and be on the Future Beef Show.
Thanks very much for having me. I've enjoyed it quite a lot, and enjoy the opportunity to share some thoughts. And if folks need to find us, go to trainag.com, and our stuff's open to the public. We're part of the farm credit mission to serve all of agriculture. And even though we're just part of a couple of associations, that's wide open to producers. So you can go out there and look at our forecasts and really that 2, 5, 10-year vision that we've got on different things. One I would point, if I can do a selfless plug.
Yeah, absolutely.
We've got a series going on called The Big Shrink, and it's really focusing on the change that's coming in terms of population demographics, not just in the United States, but Europe, Asia. Agriculture, most people say, or if you ask them, what do we need to do with food production by 2050? And everybody would say we need to double it. And that's not right.
Right.
Our consumer demographic is going to get smaller before it gets bigger.
Interesting.
And so
they reckon China's going to decrease by 20 or 30%.
And it's already overstated by 300 or 400 million people. And so it's got a lot of changes coming in terms of, we might not have to feed as many mouths as we think we do. And what's a land loan for 30 years today do? Gets paid off in 2055. The end result of this trend is ahead of when that loan gets paid off. So we've been trying to get folks thinking about, like, how do I segregate myself and not be a commodity producer? And that's hard if you're a corn or soybean farmer.
Mm-hmm.
Mm-hmm. Yeah. Beef has that beauty of it's not a commodity.
Yep.
Yeah.
Sounds like a whole other episode for a podcast.
Yeah.
So we can help you.
It does.
Yeah.
Very good.
Yeah.
Thank you for coming.
That was great.
Yep.
Yeah.
Thanks for having me.
Up.
We appreciate the relationship.
Yep.
Stay tuned. It's time for Ian, Jess, and I to go behind the beef.
No, I thought that was really good. I always enjoy getting market updates. And Dave's one of the best. And so I enjoy hearing from him and getting updates. And I'm always, I guess, looking for the optimistic view of it, but I thought it was good.
A point that I enjoy is, as an industry, we are getting better at understanding the genetic potential of our cattle and where they should be placed in the market. And I really like the emphasis from that episode on, hey, if you're going to be a high quality producer and you're going to put in high inputs, then you need to be also returning the value on those calves. And I think it's critical to make the point that as an industry, we still definitely need commodity beef, but in those scenarios, producers need to be aware that they're not the high input cost guys, that they are the low input cost guys, to make sure that they are still turning a profit or breaking even on their calf crop.
Yeah, it's neat that we have so much opportunity to add value. If that's what we want to do.
Right? I mean, I bet the chicken guys wish they had the beef's opportunity to add value like the beef industry does right now. So, I think, look, really, really interesting. Dave knows his stuff. There's plenty of reason for optimism. And, you look at the current market trends, we haven't hit our peaks. We're sitting there looking at markets last week and they were flying through the roof. And you're like, well, have we hit all-time highs? Well, most people are like, well, probably not. This time next year could be interesting. But there's always risk, and I like the point that Dave makes. Like, now's the opportunity to think about de-risking some of that. And, I think the danger is we've always in this industry, when we're on an up, we always think it's going to go higher. And then when we're on a down, we always think it's going to go lower. It's like we've never sort of managed to do that. So I think, look, some really good points there. They're dealing with that every day, obviously. And, we heard there's risk there for farm credit too. These markets take a dive. You look at what's in cattle now and, what you can buy for the same amount of leverage as what you could a year ago. Like, no one wants to see this turn without some leverage or some risk management that goes with it. So protection.
Yeah, no, I think that's right. I mean, it's interesting to look at that and look at the opportunities for leverage and risk. And I tell people all the time, I'm like, today in this market, there is no better time to reinvest in the future. Now, whatever that looks like, right? Whether that's genetics, whether that's risk management, whether that's, breeder software, whatever that is, today's the time to do it, because you want to leverage yourself for when we have one too many, as Dave said, right?
Yep.
When we get to that time, we have one too many. You want to be leveraged for that time, whatever that looks, whatever that looks like, or whatever that
however long
is.
away that is.
Yeah.
And, we didn't talk a lot about packing volume here. We probably could have had more of a topic on that, but, that'd be one area I'd say it would have been interesting to get his thoughts with these new plants opening up. What happens when a few packers close? How many have to close actually to have an impact? Probably a few now, in terms of plants. And it's going to be interesting over the next while. You look at most of the forecasts, most packers are making negative margins right now. That's not sustainable for 4 years. There's going to be stuff that has to happen to make that change. So, as much as we look it up, I think his valid point, again, I come back to that downside protection. It's a good time to think about it.
Well, it's a good time to be in the beef business, because especially when compared to other proteins, right?
Well, I get so excited about where retailers, consumers, what they're doing in terms of buying beef, the average spend that we're having by consumers, and even, that I believe it's going to get higher. Like, it's becoming a health food, which is crazy. And the tallow thing's another thing, which is just driving it even more back to beef. And
well, it's always been a health food. Let's make that clear.
Right.
From our perspective.
No,
but
from the actual nutrient quality of the beef is what I mean.
I completely agree.
Critical to say that.
Yeah.
No, it's critical to say that, but from a general consumer perception, we had everyone fighting us 10 years ago on this being a healthy product. And, that is no longer the case. And I think that's where I say that. Obviously, I'm a firm believer on it being a health product, but, I think this industry is bigger than, people in the beef industry.
Right.
So,
yeah. That was a good one.
Yeah, I enjoyed it.
It's exciting.
Yeah.
So, and look, we don't know the future, but it's going to be exciting whether it's up or down. That's for sure. Let's hope it's positive.
Well,
future of beef.
It'll be, getting back on next year and talk about, especially when we get into that.
They were the closest.
Shrink.
They were the closest. I looked at all the predictions this time last year and, a bit later in the year, but, they were the ones producing the highest uptick and they still got it wrong. It went much higher.
That's it for this episode of the Future of Beef Show. And a big thank you to our guest for joining us and sharing their experience and insights on this topic. Hit the subscribe button for more great episodes like this one. If you want to dig deeper into what you heard today, head over to futureofbeef.com, where you'll find free resources and helpful links. Don't forget, we'll pick one listener to win this exclusive Future of Beef Yeti Cooler. Follow us on Facebook or Instagram and drop us a message for a chance to win. Until next time, keep your boots on the ground and your eyes on the future.